Alrighty, so this is the 11th video under accounting and the third under the maybe series. And in this video, we're going to be talking about inventory. All right, so inventory has kind of this unique rule that you guys have to remember, and that is when it comes to the income statement. So I'll actually write that out here. We only recognize inventory when that inventory is sold, right? So let's think about this really quickly, right? Let's say that we buy inventory, right? We're going to use cash at that point in time, but we're not going to recognize this on our income statement. Now, when we sell inventory, we are going to recognize this on our income statement. And in terms of what a sale of inventory, or essentially the associated account with inventory, is called on our income statement, well, we call this our cost of goods sold, right, or our COGS. Because essentially, whenever you're selling something, right, the cost associated with that is, of course, you have your operating expenses, right, the salaries and all of that that you have to take into account. But the actual price of the good is the cost of that good being sold, right? So that's why we link our inventory with our cost of goods sold, right? So those two are really kind of connected one to one. Right, so I'll give you guys some examples here, and hopefully that will make it a little bit clearer, because I understand like when it's kind of conceptual, it's a little bit harder to understand, right? So let's say that we buy $50 worth of inventory, and we have a 20% tax rate, right? So on our income statement, on our balance sheet, and our cash flow statement, how does it impact the three? Well, we know that when we buy inventory, the rule is that we do not recognize that on our income statement at that point in time. We're only going to recognize it when that inventory, oops, that went bad, when that inventory is sold, right? So when we buy $50 worth of inventory, that doesn't do anything to our income statement. So our income statement stays flat. There's no changes. Now on our cash flow statement, hopefully this is a bit intuitive, right? All we did was buy $50 worth of inventory. So our cash is going to be down by 50, right? We paid $50 worth of cash. Another way to think about this is that inventory is an asset, right? So when our assets increase, right, what happens to our cash? Our cash decreases, right? This is kind of the rule with the cash flow statement, right? Because assets are a use of cash, right? So that's something I really stress in the cash flow video, the cash flow statement video as well, right? So when we look at our balance sheet, right, well, we know under assets, our cash is down by 50, and our inventory is up by 50. We used cash to buy inventory. So it's just kind of money that moved between those two accounts. So let's check our golden rule here. Assets equals liabilities plus shareholders' equity. Well, what happened here, right? Well, one of our asset accounts went down, which was cash, and then the other asset account, which is inventory, went up. So our assets went down, then right back up by the same amount. So this rule still stands, right? Our assets equals our liabilities plus our shareholders' equity. So we're in good shape. Now let's move on to the slightly more complicated case, and that is when we sell inventory. So let's say that we sell $50 worth of inventory for $100, right? So you have $50 worth of that inventory. That's what you paid for that inventory, but we're going to sell that obviously at a markup over what we paid for it, right? So we sell that for $100. And let's assume a 20% tax rate. Okay? So let's look at how that impacts our income statement, our balance sheet, and our cash flow statement. Right? So on our income statement, at this point in time, are we going to recognize anything? We are, right? Because on the income statement, we only recognize inventory when that inventory is sold, right? So we know that we sold that inventory. So that's going to give us some revenue, right? That's going to be an increase of $100 to our revenue. Now, there's a cost associated with that inventory, right? That's the cost of the goods sold, right? So that's our COGS. And that increased by 50, right? Meaning that our gross profit, because we're going to subtract here, is going to be up by 50, right? Now, in terms of our operating expenses, those stayed flat. That means that our EBIT is up by 50. Our interest expense, we have no reason to believe that that changed at all, right? So that means our pre-tax income is up by 50. So that means when it comes to our taxes, we made $50 more in pre-tax income. We're going to be taxed on that additional $50, right? So what is 20% of 50? Well, that's 10, right? So that means that our net income is going to be up by 40. Right? So let's move on to our cash flow statement. We know that that starts off with our net income being up by 40, so that just flows through from our income statement. But what happened in this period? We sold inventory, right? We sold inventory, meaning that our assets went down. So what's going to happen to our cash? It's going to increase, right? These are inversely correlated, right? Because assets are a use of cash, right? So an increase of an asset would be a use of cash. So a decrease of a asset would be a source of cash. Right? So our inventory is going to give us a positive 50 here because that's the value of the inventory that was sold here. So overall, our cash is going to be up by 90. Right? So it's that positive 40 plus that positive 50. So our cash is up by 90. So let's move over to our balance sheet, right? So under our assets, what do we know? Our cash is up by 90. Oops. Is up by 90. And we also know that our inventory, this is the inventory that we sold, right? That's going to be down by 50. So what happened to our total assets? So our total assets are up by 40. Any changes to our liabilities? Nope. When it comes to our shareholders' equity, that flows through from our net income. So our shareholders' equity is going to be up by 40. Right? And now we can kind of test our golden rule. So we have our assets equals our liabilities plus our shareholders' equity. Now we know in our assets, we had a positive 90, And then we had a negative 50, meaning that we netted a positive 40. And actually, let me make that in the same color here. We netted a positive 40, and we know that our shareholders' equity is up by 40. So our balance sheet balances. So to think about this a little bit more intuitively, right? We sold $50 of inventory for $100. So we made $50 worth of profit. We have to pay $10 worth of taxes on that profit, right? So our net income is up by 40. That flows through to our cash flow statement. We sold inventory, meaning that our inventory went down, which is an asset account that went down, meaning that our cash is going to increase because the two are inversely correlated. So our cash is up by 90, right? The amount of inventory that was sold plus the increase of our net income. That goes over to our balance sheet. We have $90 more in cash. We have $50 less in inventory. So our total assets are up by 40 and our shareholders' equity is up by 40. So that's how I'd kind of walk someone through a sale of $50 worth of inventory if you were to sell it for $100 at a 20% tax rate. And remember, if we just buy the inventory, no changes on the income statement because we don't recognize it at that point in time, all that happens is we use some cash for inventory. So our cash went down, our inventory went up. So overall, I hope that's been helpful.